Will and Alex, really appreciate you taking the time being here. To get things started, can you tell us a little bit about yourself and your backgrounds?
So thanks, Ed, and thanks for having us. And yeah, we've really enjoyed our partnership with Firmex and your product. It's really helped our practice grow and given us the flexibility where we need it in an offering to our customers, our clients. And so appreciate that. And so happy to be here, Edward. And I joined this industry as a business intermediary in 2007. My professional career originated from the legal side of real estate and commercial transactions. My first business venture post law school was a supply chain technology company that aggregated purchasing power of independent supermarkets in New York City. If that business would have succeeded, it would have looked a lot like the company Instacart is today. So that's where I come from, and working as an intermediary now for about 14 years. Lesson learned from everything that I've had is just to stick at it, keep with it, and don't give up. So,
yeah, thanks, Ed, for having us, and it's a pleasure to be part of your video here, having worked with Firmex for over a decade now. I come from a significant I come with significant international experience, having worked in a variety of real estate consulting, real estate direct investment capacities in Europe and in the US. When we set up Beacon in the 2009, 2010 period, our goal was to help entrepreneurs while being an entrepreneur. So this has been our mantra, and our goal was to be able to assist business owners who generally cannot or should not or are not able to get assistance from larger organizations and are looking for people that are in very similar shoes, that have started their own business, to really spend the time and understand their specific business and how to assist in the process of selling that.
That's great. I appreciate the introduction and I appreciate the kind words about Firmex. We definitely appreciate it. I think you've been with us for a long time. I think you touched on this a little bit, Alex, but maybe you want to. I don't know if you want to expand on it a bit more. But can you tell us a little bit about Beacon Advisor specifically, and what you look to do with it? That could be either for Alex or Will.
Yeah, absolutely. When we started Beacon, the idea was to develop a company that would be an M&A advisor or a quasi-boutique investment bank that would be really focused on small to mid-size family-owned businesses. At the same time, that doesn't mean small businesses per se in terms of size, but that means businesses that are quite often maybe not as sophisticated, quite often maybe do not lack the internal financial controls and resources of larger organizations, and really need an advisor to be able to assist them in what is a true marathon, which is the sale of a business. So this has been our goal. And over the years, with the assistance of partners like Firmex, we have built a technology-driven business that has been able to assist now well over 150 companies in successfully transacting them.
Alex, I echo your sentiment that the business is technology driven, which it has to be in today's environment. But I really like the word you use, marathon. It is a marathon to sell a company, and it definitely takes an entire team to win that goal. And so at Beacon, I spend time getting to know our clients and understanding their goals and their motivations when it comes time to selling their business. I'm also very involved in the sales and marketing aspect, which I find very interesting and challenging, because as you know, in the last 14 years, media has changed significantly from the way things used to get done. When we started this company, we were using Canada Post and the mail services to disseminate our information. Today, it wouldn't even be a part of that equation. And so it's a very challenging and interesting marketing environment that we're in.
Yeah, that's a great description. And definitely I guess I've been at Firmex quite a while too, and I've seen how deals have changed since I started. Does Beacon Advisors, do you specialize in specific industries, or are you more general?
I would say we're generalists in that we will consider any opportunity that is presented. We'll get a chance to understand it. We'll weigh our calculate our ability to be successful in a deal. More often than not, we'll accept the challenge. Obviously, if it's in certain very technical fields like aerospace, then we'll leave that for people who are specializing in that type of stuff. But we will consider any opportunity and gauge our ability to be successful in it. And we because our office is based on a team approach, everybody on the entire business of our company will be looking at an opportunity and giving their input to understand if this is something we're going to be able to do.
I like the comment about accepting the challenge. It's definitely something that you do not get into, which is our business, unless you do like challenges, because every day is different. Every company is different. We certainly are generalists from a point of view of an industry, but at the same time, we are very focused on these companies that are kind of, 5 to 50 million in revenue, which makes for the majority of our clients. And despite the fact they might be across various industries, the challenges, certainly some of the common issues, but also opportunities, and the way that we look at transacting those companies and extracting maximum value is pretty similar.
I think that the fact that you're generalist puts you in a unique position to kind of see what's going on across the lower mid-market space in general. What are some of the most common questions clients are asking you right now, whether it has to do with valuations, macroeconomic effects, when to sell their business?
Yeah, the question I'm most often asked by sellers is it a good time to sell, Will? And I probably get asked that 4 or 5 times a day. And my answer is always, it depends on you. There are so many variables that business owners need to consider when they're considering a sale. The number 1 and 2 stumbling blocks that we see time and time again are balance sheet issues and post-transaction tax implications or considerations. So one of the first considerations is whether a business owner needs to ask themselves is, will they be taking advantage of a small business capital gains exemption, which then dictates if we are going to be selling shares or assets of the company. And part of that consideration is the balance sheet. Is the balance sheet sellable in a sellable condition? Balance sheet should be free from assets that are not going to be included in sale, like marketable securities or real estate that the business owner over time has added to the company for various reasons, but realizing that if a sale is imminent, these things need to be excluded from a sale and removed from a balance sheet prior. Another issue, or another thing that when I'm asked if it's a good time to sell, or and we always suggest, is that any business owner considers the post-transaction tax implications of a sale. So obviously, it's timely, at least 2 years prior to considering a sale, is that you work with your tax advisor and get an understanding of what those implications might be. So that's it in a nutshell.
Alex, do you have anything to add?
Yeah, on a less technical note, if I have to identify, one of the most common questions I get is, who would be the likely buyers, and who would want to buy my business, or who would buy my business at a premium? So those are kind of all variations of a same sentiment among business owners, which is, I really don't know, but I'm sure there's somebody out there who would like to buy my business, would see a lot of value, and hopefully is willing to overpay, not in a bad way, but at least pay a premium for my business. So that's probably the question that I get asked the most, and the answer quite often once we embark on a process is surprisingly varied, and this is the reason why I almost don't want to answer that question in a way that it's black and white to business owners, because companies that we have thought would be a perfect private equity fit, or where we thought the buyer would be a private equity firm, ended up being bought by another individual, and companies that we absolutely were certain that would be only owner operator would be interested in them got acquired by fairly sizable financial buyers. This is just a small example, but certainly gives us an understanding or humbleness to sometimes answer the questions by literally letting our clients know that the market is the one to dictate all of this, and we're just the intermediaries who try to extract the most value by exposing it the right, confidential, and professional way to that market.
That makes sense. Will, you mentioned that they should be talking to their tax advisors 2 years in advance. For someone who's I guess looking to sell their business for the first time, in their head, how much time in advance should they be planning the sale? So if they it's definitely not something you can do in a few weeks, but should it be 2, 3, 4 years they should be thinking ahead?
Well, I think at a minimum is at least 2 years. I get a lot of calls where people are just not ready for the reasons I've stated. 3, 4 years is a bit long, but you definitely want to have certain things tidied up and ready, at least when you're calling Beacon to get involved. But again, it's a marathon. I've worked with clients for over 6 years, from first time we meet until we've completed a transaction, and helping them, get the preparation done, advising them what they need to do, and then ultimately getting the company valued, out to market, and sold. So it takes time. 2 years is a good place to start thinking. The knee-jerk reaction we often hear or see sometimes is, I'll get a call early in the morning, so I've decided to sell my business, and how do I do that? And so it's those are good calls, they're interesting calls, but quite often it can't be done within a few months. It takes some time.
Yeah, when should people start to engage with advisors? So when's a good time? So if they're prepping at 2 years, should they be engaging with Beacon at 2 years to start those initial conversations, or should it be a little bit later?
I love getting to know people. That's my favorite place to be in my company, is talking and working and getting to understand people and what they'd like and what their motivation is. And so for us, yeah, it's a good place to start. It's we like to call it a placeholder, where we'll have an initial conversation. We'll send them back with some homework to do, get themselves prepared. I've just did this just the other day with a fellow. Called me, wants to do this, that, and the other, sell it and have it done, be at the cottage by the summer. And I said, well, these are the 2 issues that we see. If you can fix them up, then we can get to market. It for us is formulaic, but understanding that most people selling their company is a once in a lifetime event, and for the size that Beacon works in, $1 million to $50 million revenue, and that there is some more prep that's required. Just really balance sheet and tax implications.
As first-time people who are selling their businesses for the first time, do you have any advice on how they pick an advisor and how they pick an advisor that's right for them?
A lot of people come at this thinking that you need an advisor who's done work in your industry. And so, we like to say, well, that's an interesting way to qualify somebody, but it's not the only way to qualify somebody. Just because the advisor you're talking to hasn't done any transactional work in mill writing doesn't disqualify them from actually being successful in helping you get that deal done. In the space that we're in, which is 1 million to 50 million revenue companies, it's not so much industry specific or industry experience that drives a deal. It's more so the advisor's experience in keeping a deal moving forward, finding and connecting with the buyer who will carry the torch, and again being able to coordinate with both sides on a deal to drive a process forward to completion. So that's one thing, is that industry related experience is not completely necessary, but you also want to pick advisors who come from various industries prior to being an advisor and have experience in that particular industry. So I come from a legal and real estate background. Alex comes from commercial real estate as well. We have other people on our team that are chartered business valuators, chartered accountants, and so we run our shop really with people who come from a professional, who have various professional designations, and that's how we run Beacon, that type of professionalism.
You mentioned balance sheet issues, and I think this is slightly related. But how do you go about valuing businesses? I guess this is a broader question. It's not just balance sheet, but I'm thinking along the lines of like all the government subsidies that have come in because of COVID. And then also there's the government subsidies component, but there's also like the market components to COVID. So like some businesses thrived during the pandemic. Others, such as the travel industry, might be experience historic one-time lows. How do you go about valuing a business with these like one-off world events happening at the macroeconomic level?
The biggest thing about, or the most interesting thing about government subsidies is it's almost sparked a debate among industry professionals and business valuators how those should be treated. And on one side of the equation, you have the thought that it's almost a perfect reflection of the temporary slowdown and loss of revenue that those companies would have incurred or had incurred during the pandemic. And the subsidies are a reflection of what their revenue and therefore, going down the line, the bottom line, would have been if that didn't happen and there was no pandemic. On the other side, you have the thought of you can't really do this because it's a one-time adjustment that needs to be made. It's a non-operating income if realized as an income, or one-time reduction in expenses if related to reducing your expense lines. And the world is not going to, or there will be changes in the economic environment and businesses that cannot be predicted because of the pandemic. And if the business incurred such big losses during the pandemic, probably will not fare well after as well. So they shouldn't be adjusted, they should be adjusted as a reason to that. So the most interesting thing about it is that right now, with the subsidies being at their tail end and pretty well over, this would really settle the debate, because that would show to what extent companies will bounce back to the levels that they were pre-COVID without them, and whether those bottom lines would start to show numbers that were similar to what they were doing before, or they would be long-term affected by the pandemic, and therefore, show that those subsidies were just a temporary patch to the business, rather than, at the moment, just a perfect reflection of the economic reality at the time. So that's as far as the valuations are concerned, related to those government subsidies. The other issues again, somewhat valuation related, but also related to the balance sheet of those companies. It's in a lot of cases, some of those government programs were loans. So obviously, increasing the loans on your balance sheet and reducing the equity value, as we assume that even though maybe the valuations have gone up during the pandemic to certain businesses, they certainly didn't jump as tremendously as, let's say, real estate. And if the value creation occurred in some industries, it occurred to a much lesser degree. So when your balance sheet all of a sudden starts having a lot more debt, that automatically reduces the equity value of your business, and that certainly creates longer term implications when wanting to sell the business and the value that you can generate as after tax proceeds in your pocket as a seller. So there's quite a bit of a debate, but also I'm looking forward to kind of seeing how companies do fare, because we do have some metrics of even dealing with those subsidies when we create valuations at the moment. However, they're not perfect and usually are based on certain assumptions. And now that they will be gone, it would be very clear whether the assumptions we've employed or other advisors have employed would reflect reality when it comes to the valuation of those businesses.
I might be putting you on the spot here, but do you have any like early indications of what side of the debate you're falling on? Whether or not the subsidies are more of a patch and are just like they're giving the businesses the revenue that they would have over the period of COVID if COVID didn't happen, or are you seeing it the other way?
I wouldn't say that I fall on one side or the other across industries, but I definitely have seen this to be certainly a patch for certain industries that are going to have long-term pain from changing consumer preferences and consumer behaviors and supply chain disruptions or any other issues that we're witnessing. And I certainly see that industry specific kind of answer is the way to even approach those. And certain industries truly were in just a very temporary slump because of shutdowns or because of certain things that happened as a result of COVID, and certain industries did really change. So I think the short answer is that it really depends on the industry, and it's not one answer that can cover it all.
That makes sense. What opportunities are you seeing as a result of current macroeconomic trends? And just for context of the listeners, at the time this is being recorded, there's obviously a horrible war going on in Ukraine, and I'm not necessarily talking about that so much as there's other trends like questions about inflation. Obviously, we talked a little bit about valuations being affected by COVID, and I guess the COVID recovery. But like, what kind of opportunities are you seeing right now, either in an industry level or a company level?
Well, that's an interesting question, because there's always opportunities when markets shift. Even during the pandemic, there's been so many opportunities for certain industries or certain businesses, and certain businesses that have adapted and have made the necessary steps or taken the necessary steps to position themselves in light of the kind of the new world, whether it's macroeconomic or locally, are in much better position right now post pandemic. As far as the macroeconomic trends that we see in some of the things that are affecting businesses and M&A in that matter, I definitely see a trend towards a less global and more local businesses being a lot more interesting to investors because they do insulate the kind of the macroeconomic problems that we're witnessing. And it is becoming more and more clear that those macroeconomic issues are here to stay, and whether it's companies dealing in different ways with pandemic and therefore different effects on their economies, whether it's obviously, as you mentioned, other global things like even wars and things of that nature. It seems like investors are shifting their attention to more businesses that are generating good amount of cash flow in economies or geographies that they see as stable and less prone to those macroeconomic disturbances. Perfect example, the most local businesses, real estate and real estate related construction. And while this to a large degree has been fueled also by low interest rates, a lot of that has been driven by the fact that there's very little impact on demand for real estate that relates to anything going on outside of, let's say, the certain markets that those companies are active in case in point, the Canadian market. So the local versus global is definitely something that I see a little bit of a shift. At the same time, when we talk about global businesses, they're still of interest to investors as long as there's not a huge investment in infrastructure and assets globally. So we see a lot of global service or IT or SaaS businesses that are truly global, be very much in demand. And that, of course, has to do with the major advantage of global businesses, which is diversification. So as long as you have your main asset is your labor and your people, then and you're not investing heavily in places or in geographies that you then might have trouble getting out of if anything happens. As long as labor and people are the main asset, we see those global companies still be very much in demand and continue to be desirable M&A targets.
Makes sense. Are there any specific industries, like I think you're unique in that you're generalist. Are there any specific industry segments that you're seeing increased interest in? That could be for Will or Alex.
Lately we've seen an increase in technology and SaaS-based businesses that are entering the market, and so typically Beacon has attracted distribution, manufacturing, service, and contracting, but certainly tech and SaaS are companies who are looking to transact are now calling us to help them with that exit. So it's definitely been a change in the last couple of years, and so we welcome it because we love the challenge.
And as a more defensive play, we definitely see a lot more kind of conversation we're having with buyers about companies that have government related work and companies that do work with the government. And we saw the exact same trend in the last recession of 2009, where those revenues all of a sudden were viewed as a lot more stable, and certainly in any kind of situation that there's less clarity about the private markets, certainly the government is the one to step in and offer more opportunities for businesses. So we definitely see that, as well as some local manufacturing companies that have less dependence on overseas supply chain, as well as food processing.
I guess I'm interested in like the increase in the tech side. Do you have a hypothesis or an understanding as to why that increase has happened? and what's driving that?
I'll just fathom here a little bit of thought that some of the tech companies that were created, I guess, post meltdown of 2008, have matured, and they're entering this mature stage where they're a viable company looking for an exit. And so recently, we've sold tech companies like this, where the owners have built something. It's mature. It's cash flowing stable year after year, and their entrepreneurial spirit is pushing them to go and start something new.
And I think to a great degree, technology has permeated industries that were adverse to technology or didn't have technology as significant component of their business model. So I think there has been a development or growth of technologies because of the adoption of technology within certain industries. And in that regard, when we say a technology business, all of a sudden we're not just talking about software development businesses. We're talking about, there even about fintech companies, where there's so many variations of what that really means and how they are used in various industries. But also there's all kinds of very unique ways that companies are starting to adopt technology that makes even companies that were not really technology companies now move towards that kind of area. So it's as the world and the industries are adopting more technologies, companies could be attributed to be called or be positioned more as technology-driven businesses. As we said even at the beginning, we are not a technology business ourselves, but we do employ a significant amount of technology to facilitate the work that we do, and I can only see that move in the exact same direction going forward.
Like, as an M&A advisor, adopting new technologies, and you're obviously considering yourself like a tech-enabled business at the very least. How does that add value to your clients?
Well, let's look at the use of Firmex. So I think it's been 10, maybe 11 years. We've used Firmex in-house to host the transmittal of confidential data between our buyers, our sellers, and all of their advisors. And so we implemented this very early on as part of our offering and as part of our unique service. We've the use of a CRM. How many NDAs are getting signed on a daily basis at my company? When we first started, I think I remember seeing some people in my previous organization. There was one person in charge of just printing and faxing out NDAs, and so things have really come a long way with all the technology that surrounds this business.
I think the biggest testament of how this business has changed is that probably just thinking back the last 10 clients that we have transacted businesses for, I think I might have met in person with maybe 3 or 4. And that is unfathomable or unthinkable, especially given the fact that a lot of those companies might be in very traditional industries with kind of the baby boomer business owners, the kind of people that, just a few years ago would literally say, I am not hiring an advisor unless I come and meet with you and we spend time and we spend a lot of face-to-face together. And that's a perfect example of how mentality has changed in among industries and or business owners that you never thought that change would be so drastic.
Do you see that change persisting as things start to open up, or do you think people will go back to needing to sit down with their advisors across the table face to face?
We always encourage meeting face to face if that is something that the owners would feel more comfortable with. I think it really depends on the person, but I think, as we discussed even earlier, there are certain things that are long-term trends that are, as we're coming out of the pandemic, are going to persist. And I think the comfort level of people dealing with people without having to physically meet, and all the technology that enables this, and all the means of putting all the controls and processes in place in order to facilitate that, are certainly only getting better and better. So I don't see that becoming a trend that's less pronounced, and I certainly think that the comfort level of people dealing remotely would remain.
Are there any limits to diligence, doing diligence remotely? Are there parts of the process that just can't be done? I guess this might depend on a company versus industry versus industry. Obviously, a tech company is probably more suited for remote diligence than an industrial company. But
I mean, combination of the two is always preferred, because the biggest asset by far, and that has become more and more pronounced lately in any company, as far as much as we talk about technology, the biggest asset of a business is the people. And there is no way to gauge that and understand the nuances of a company's culture, as well as the people behind it, and their skill set and their abilities, than having some type of face-to-face interaction one way or another. So in that regard, face-to-face and spending time, or being able to visit businesses and engage with some of the upper management, and even some of the observe the employees, it's absolutely invaluable.
yeah, that makes sense. And I've heard throughout the pandemic, and I don't know if you're seeing this as well, but some buyers and some advisors are leveraging technology to get more, to build a deeper relationship or understand more about the management team. Like, there's examples of, like, I've heard some deals where because of COVID, the company started doing podcasts. So some of the executives were doing podcasts, and the buyers were able to get a feel for the executives that way. Or because you don't have to have, like, everybody meeting over the course of a few days when everyone's in the office, you can have more meetings more often with members of the executive team. Do you see that happening? Do you think technology can be leveraged to increase those relationships pre-sale?
Yeah, I think definitely what we have noticed is the blurring of geographies and borders when it comes to team integration. I literally, in the middle of a transaction where the main person that we're dealing with on the operations side, that is the advisor, the operation person is based in Spain, the CEO is based in the UK, and the team that we're working with on the due diligence is here in Canada. So technology has certainly made that available, and has made kind of that geographic boundaries almost irrelevant. So from our experience, that is probably the one aspect that we see is a very new development, because I remember selling businesses 6 or 7 years ago that the CEO had to fly in from France and had to spend time with us in our office and do all the introductions and introduce their team members who also came over, and then literally was just a face-to-face kind of introduction to get a comfort level with us. Now we have hired people without meeting them in person, and we certainly have dealt with people that are all over the world, that you never thought that a seamless kind of work can take place, but it does.
Another result of the pandemic has been easy access to capital, obviously historically low interest rates. What, if any, do you think this has had on valuations?
We're seeing multiples increasing during the course of the pandemic. Not sure if this is tied to a perceived lack of supply of businesses that are coming to market, given the fact that on the size of deals that we work on, those business owners are cash flow dependent, and they've decided to postpone any possibility of sale until the pandemic has played itself out. But certainly a 3 times multiple during the pandemic from the seat that we're sitting in, we're seeing a 3 times go to 3.5 or 4 times now, and people willing to pay. Also, obviously, access to capital plays a part of that as well.
Yeah, from my point of view, the biggest effect, it's probably a net negative effect. However, again, industry dependent and business dependent. But what we are seeing is, as Will mentioned, multiples certainly going up. However, at the same time, because of the ease of that capital, we see leverage go disproportionately higher. So while the total valuation of a company goes up by 10% or 15% because of some of those increases in multiples, their capital structure changes disproportionately in favor of debt, which eats up into the equity value of the business. And that, to me, is disconcerting going forward, as certainly businesses that have high leverage are a lot less likely to withstand significant economic or business impacts.
Yeah. Is there a risk of, and I'm not super familiar with corporate finance, so there might not be, but is there a risk of interest rates increasing? So if a business is highly leveraged and they're more exposed to debt, as interest rates increase, does that put more pressure on the business?
Certainly, there's a direct correlation between obviously servicing of the debt and those expenses as it relates to the cash flow position of a business. However, most businesses that have to be worried about this are probably not positioned very well, because you hear all this stress tests that are being done for, business owner individual owners going to get financing for a house. The bank would like to see, okay, how would that repayments look for that individual if the interest rates go by 3 or 4% higher than where they are right now. What happens is, businesses, they have to do their own stress test. And when I say stress test, that's not just, can I afford the payment on my debt if the business goes up or the interest rates go up by a point or two. They need to do the stress test as it relates to their business, which means, let us look at our client concentration. What happens if I lose one client? And if that client accounts for 30% of my business? Let me look at my supply chain. What happens if all of a sudden it takes 45 days for me to get the product here instead of 30 days? There's so many things that the business needs to do their own stress test that relate to the ability of the business to continue to perform well, that are way more important than worrying about servicing the debt if the business interest rates go up by 2 or 3%. So that is what we are trying to convey to our business owners. Capital structure is not what you need to worry about. Capital structure should reflect the way that the business can comfortably run and make you feel very at ease when you go at night to bed, and feel that there's hardly anything that can get that business to go belly up, or at least you have put all the things in place that 2 or 3% interest increase, or any kind of increases in minimal wage, or increases in certain payables as it relates to employees, or insurance. They're not going to push that business over the edge because you have created all the other things in place.
Yeah. That makes a lot of sense. That's a really great answer. I think it's a good spot to end the conversation. Is there anything else either of you would like to add as we wrap up? Anything we didn't cover that you'd like to say?
Yeah, I think sometimes people want to know the advice, some advice. What advice would we have for a first-time business owner? What would be the advice for a first-time business seller? And typically, we like to say that just remain flexible. Remain flexible in your expectations of what that buyer might look like or be like. Be flexible in your expectations of what the transaction might look like, and be flexible in the amount of transition time that you can offer. And so these are the types of advice that we'd like to give people when they're thinking of selling a company.
There's so many things that go into selling a business that if I can just leave the audience with a few key pointers, and when I say audience, by far and large, I think of entrepreneurs who are thinking of selling their business one day. Be prepared. Talk to an advisor or advisors. Keep in mind there's always three parties to a transaction: the buyer, the seller, and the government. So tax is important to consider. But probably one of the more important things is prepare for a marathon. Try to leave emotions on the side and put yourself in the buyer's shoes when you're trying to put a transaction.
That's really good advice. We'll leave it there. Will and Alex from Beacon Advisors, it's been a pleasure speaking with both of you. Really appreciate you taking the time to sit down with us. It was a very informative chat.
Thanks, Edward. Really nice to meet you, and thanks for having us.
Thank you, Edward, and it was a pleasure, and thanks, Firmex, for doing this.